welcome to the Monday Futures Market Outlook for November 29th, 2010. This is Patrick Srezna. For those of you that have not had an opportunity to try out eminisource.com, 30-day complimentary memberships are available on the website, no credit card required. As always, I start off with a weekly chart of the S&P 500 going back 3 decades, and we plot an 80-week moving average on there. It does a very good job to depict the bull and bear market cycles that the market has gone through. We were suggesting that when we were correcting over the summer that if we saw no major breakdowns below that 1,000 level on the downside, that this would be nothing but a flagging formation before a continuation rally back up to the previous highs, if not a push even as high as the 1,300 level on the upside. We still are of that conviction. We believe that at this moment this is just a profit-taking cycle, that we'll still have one more leg higher in this market. In the bigger picture, there might be some bearish cross currents in 2011 that maybe in the second half of the year may drive a new sell cycle, but at this stage, especially going into the first quarter of next year, we still have the bias that the market should progress higher. When we take a closer look at that S&P 500 on the daily charts using the E-mini futures contracts, we more or less last week were saying that if the bulls wanted to reverse this market off that flagging formation, they needed to break it above this 1200, 1205 area. And if they did, they would open the window for not only a retest of the previous highs, but would also open the window for a potential break all the way up to that 1240, 1250 area on the upside. But more importantly, we were suggesting that if in fact we were not able to break above that, that the bears would remain in control of this market and what would be a flagging formation on the downside, which would head down toward our measured move target around the 1150 area. And that continues at this moment to be the scenario that appears to be playing out. We would need to see a break below that 1175 area where all those lows came in over the last couple of weeks to really open that window for another 20-25 points lower. Now, in the bigger picture, we still believe that this will be a flag or a wedge. So when this move downwards there finishes, even if it was dramatic and even dropped to 1130, we would still be looking for that market to turn up and come back to its previous highs. Under what circumstances could we see such a sharp drop? Well, if the Eurozone continues to drive downwards the market and the euro starts heading down toward the 126 level, the strength in the US dollar and subsequent correction in commodities would certainly be enough of a catalyst to drive a sharper move lower like that. Just to review our key points, we are now intermediate bullish on the markets with short-term risk of continued profit taking. We were suggesting again that 1205 level, if it was not beaten, that the window would remain open for multi-week correction down towards 1150. If the bulls want to reverse this market right now, they need to hold these support lines at this 1175 level and then get back above the 1200, 1205 area. So that would be the only circumstance which we would consider bullish scenarios. We would need to see that price action bullishly break above that area. Longer term investors could start be buying here, but would have to stomach the risk of that deeper profit taking cycle. But I still believe that this pullback will be an opportunity to buy. Next here, I want to take a look at the E-mini NASDAQ 100 on the daily charts. And we see exactly that a little rally higher that came up to retest that zone. We still believe that if the whole market here is going to correct on the S&P, that the NASDAQ will at minimum come back to retest the 2100 area, if not break all the way down to 2050 on the downside. But again, that would only be a buying opportunity if we got that. In the same regard, so if the S&P got back above 1200, and that corresponded with the NASDAQ breaking above the 2150, 2180 area on the that could actually open the window for the NASDAQ to break to higher highs and go. So more than likely, NASDAQ will remain the leadership group, and so we'll be watching for a lot of the positive price action from the NASDAQ as an indication towards the S&P. When we take a little closer look at the dollar index here, the dollar actually came up towards a pretty significant overhead resistance at this 80-50 area and just blew through it like if it wasn't even there. That is a very strong positive. We drew in that blue line last week saying that a break of 79.50 really opened that window. At this stage, There are some measured moves that head up toward the 82 level. I don't believe we'd straight line move all the way to 83, but at this stage, the euro weakness, and if you look at a chart on the euro versus the US dollar, really all the support lines have been broken on the downside. So depending on how far the euro goes, with the dollar being so heavily weighted in the euro and the British pound, it's certainly going to continue to rally if the eurozone weakness persists. Next year, I want to take a look at gold futures, and we have something like a head and shoulders pattern starting to look like it could develop. We were suggesting that any rally that failed to break above this 1380 area would certainly start to open the consideration that there's another leg lower in gold. We are still of that conviction that the next gold rally shouldn't really occur until next year, and then it would be very healthy for the gold market to spend the rest of this time horizon to be correcting for the remainder of the year. What would be if this high comes in here, gold should not only be retesting the 1320 area on the downside, but realistically some of these measured moves go all the way down to 1300 and lower, even potentially down to even 1280 on a corrective move downwards. Now once that correction persists and we see some good basing, that will probably end up being a good buying opportunity in gold, but we are skeptical about gold making new highs here. Next here, I want to take a look at a chart on crude oil, and when we're seeing this here, we were looking for overhead resistance at the 84 level, where the highs came in October. We had a little bit of a pop higher toward 85, but we still haven't actually beaten any of the retracement zones. At this stage, we're still believe there's a chance that crude oil will reverse back down to retest even that 79.80 level on the downside. But if it does test down there, it will be driven by a weakening euro and the strengthening dollar as it pushes down there. I find the scenario kind of hard to picture a scenario where crude oil rallies all the way back to its previous highs while the US dollar is rallying in such a robust way. So we're looking for somewhere here, there's some sort of a pattern that indicates that crude oil is reversing. Finally, I want to take a look at the 10-year Treasury notes, and we've seen a breakdown of that important 125 level on the Treasury notes. We were looking for a drop down toward the 123 handle on the downside, where the supports came in the July and September time frames. Really, we saw a lot of hesitation for follow through, but that doesn't change the fact that there's a lot of overhead resistance and a lot of room for Treasury bonds to drop at least 1.5 full points on the downside. So at this stage, the only way we would consider a more bullish scenario for 10-year Treasury bonds would be a rally above the 125.5 area with some significant follow through. It should be obviously be driven by some sort of fundamental reason, and if we got a technical break there, then that would be the only scenario. Right now, anywhere below this 125 level, we remain skeptical about a rally and see this potentially still testing the 123 area on the downside. That was the Monday Futures Market Outlook. Thank you for joining me.